Today we are going to speak about the gold-oil ratio. Now, there is a link essentially between the price of gold and the price of crude oil. And this essentially comes about in two parts. The first is that the price of crude oil, when it increases, it would lead to inflation. And this would mainly be because the price of petrol, diesel, essentially transport fuels would go up, and that would make the items itself more expensive, which would lead to inflation. The second part of this logic is that gold is a good hedge against inflation. So when inflation increases, then demand for gold increases, making the price of gold go up. And therefore, through inflation, there is a link between crude oil at one end and gold at another end. This is essentially a logical link, it's a casual link, but it is not a firmly mathematical link. However, because there is a logic, it can be explained in an essentially simple way, which is that how many barrels of crude oil would 1 ounce of gold buy at any particular time. So we actually put a table in place to see how this has been working over the years and how we can use this gold oil ratio to make an investment decision in gold. And this is how it would be. So we are going at the year and the number of barrels of oil per ounce of gold can buy. So in 1970, the ratio was 10.27, which means that 1 ounce of gold, you would be able to buy 10.27 barrels of crude oil. And then it went down. Today the price of gold is $1,256 per troy ounce. And the price of crude, WTI, is $103. Now, 1256 by 103, which is the number of barrels which would be bought by 1 ounce of gold, is 12.2. So the ratio today is 12.2. What is striking in this table is this. In the year 2000, that ratio was at 9.54, which is that 1 ounce of gold would buy only 9.54 barrels of crude oil. And the price of gold was essentially the lowest generally in that period. So which brings us to one conclusion from this table. Anything below 10 does not seem to be sustainable according to history. So when you factor in your decision to buy gold, this is something which you must look at. This ratio, the crude oil to gold ratio, if it falls below 10, then it is an indicator that buying gold at this point can be a good idea. But by no means this is the only factor to consider. There are several other factors which will affect the price of gold. But definitely if you look at history, then when this ratio goes below 10, you must give a good look at your investment decision of investing in gold.